Most people think the Federal Reserve targets inflation or unemployment directly. But in reality, there is something else the Fed is constantly watching. Something more important. Financial conditions. Financial conditions describe how easy or difficult it is for money to flow through the system. Not just the cost of money, but the overall environment for borrowing, investing, and taking risk. It is not one number. It is a combination of factors. Interest rates, credit spreads, stock prices, and the strength of the dollar all come together to shape financial conditions. When financial conditions are easy, money flows freely. Credit is accessible. Asset prices rise. Risk-taking increases. The system expands. When financial conditions tighten, the opposite happens. Credit becomes harder to obtain. Markets lose support. Risk appetite falls. The system begins to slow. This is why the Fed does not just look at inflation data. It looks at how markets are behaving. Because markets themselves are part of the transmission mechanism. If stock markets are rising, credit spreads are tight, and borrowing is easy, financial conditions are loose. Even if interest rates are high, the system may still be supportive. And if markets are falling, credit is tightening, and the dollar is strengthening, financial conditions can become restrictive, even without major policy changes. This is the key insight. The Fed sets interest rates, but financial conditions determine how those rates actually affect the real economy. Sometimes the Fed raises rates, but markets remain strong. Financial conditions stay loose. That means policy is not as tight as it appears. And sometimes the Fed does very little, but markets tighten on their own, liquidity pulls back, risk falls. Conditions become restrictive without the Fed acting directly. This is why financial conditions are the real target. The Fed is not trying to control a number. It is trying to influence the overall environment. If you understand financial conditions, you stop looking at individual data points in isolation. You start seeing the system as a whole. And once you understand financial conditions, the next step is to understand what the Fed is actually watching when it decides whether the system is running too hot or starting to slow. In the next video, we break down CPI versus PCE, what the Fed actually cares about, and why markets pay much closer attention to one inflation measure than the other.